November of 2025. I mean, it was pure market whiplash. One minute, there was absolute fear everywhere. The next, we're suddenly touching all-time highs. So we're going to break down exactly what happened, and more importantly, figure out what truly protected investors through all that chaos. I bet the answer isn't what you think.
I mean, this was the reality. And you probably felt it, right? That roller coaster feeling, with headlines screaming about an AI bubble bursting and a recession just around the corner. But then, almost as fast as the panic started, poof, it was gone.
So this all leads to the one crucial question. Was the key to surviving all this trying to perfectly time the market's next move, or was it something deeper? Something you should have had in place long before the panic even began.
Let's just be super clear about this from the get-go. The answer was not prediction. It was, and honestly, it always is, good portfolio design. And that's the whole idea we're going to unpack right now.
All right, here's our game plan to get from chaos to clarity. First, we'll quickly relive that emotional whiplash. Then we'll break down the month's three-act drama. After that, we'll dig into the market's new rules, and we'll finish up with some real, actionable strategies you can use for 2026.
So, let's do it. Let's just quickly revisit that journey from fear to relief. It happened so fast, it's almost easy to forget just how jarring it really was.
In early November, the entire story was driven by fear. All this talk of an AI bubble, tariff wars, a government shutdown, it led to a ton of emotional selling. But by the end of the month, the story completely flipped on its head. AI demand was confirmed, the market got really confident about rate cuts, and guess who got rewarded? The people who stayed structurally invested. The key takeaway here is that reacting to that first narrative, well, it cost people dearly.
Okay, now let's break down the play-by-play. This wasn't just random noise. It was actually a pretty clear three-act drama that unfolded over just 1 month.
Act 1 was all about fear. Doubts about AI valuations, tariff threats. It sent the VIX, the market's fear gauge, absolutely soaring. Then came Act 2, relief. The shutdown ended, we started getting economic data again, and things kind of stabilized. And that brought us to Act 3, the rally. We got strong AI forecasts, a much more supportive or dovish tone from the Fed, and all those Goldilocks hopes came back. An economy that's not too hot, not too cold. And that's what sent the market right back to its highs.
But here's the thing, the timeline only tells us what happened. To really get it, we need to look deeper at the why. The fundamental rules of the market were actually shifting right under our feet, and understanding these changes is the real key to figuring out what comes next.
This slide really lays out the 3 big shifts in the market's mindset. First, the focus on AI went from just pure hype to demanding real earnings. Second, the main fear switched from inflation to whether we could actually stick a soft landing for the economy. And third, the market started to price in geopolitical risk, basically absorbing the news without freaking out. Let's drill down on that first point, because it's a huge deal.
Right, so the AI label by itself, it's not a golden ticket anymore. The market is getting way more selective. It's looking past the buzzwords and asking, show me the money. Are you actually making a profit from this? The companies that could show a clear path to profitability were the ones that really led the recovery. This shift, along with the new focus on a soft landing and the market just getting more mature about global events, created a whole new playbook. And a new playbook, well, it needs new strategies.
Okay, so we've covered the what and the why. Now for the most important part. How do we turn all this analysis into a concrete action plan for your portfolio?
First things first, it is probably time to graduate from being over-concentrated in tech. Now, don't get me wrong, AI is incredibly promising, but valuations are high, and that recent rally might mean your portfolio is dangerously lopsided. The smart move isn't to dump all your tech, but to rebalance some of those profits into other strong areas of the economy.
So where could that money go? Well, we're looking at sectors with their own solid fundamentals. You've got financials, which benefit from a strong consumer. You have healthcare, which offers stability no matter what the economy is doing. And then there's industrials, which are getting a direct boost from building out all this AI infrastructure.
Strategy number 2 is all about positioning your portfolio for the next big shift, lower interest rates. The Fed's rate-cutting cycle is on the horizon, and that's going to be a huge tailwind for some of the sectors that have been really held back by high borrowing costs.
So while everybody has been laser-focused on large-cap tech, strategic investors should probably be looking over here, at bonds, which tend to do well when rates fall, at small-cap stocks, whose profits get a nice boost from lower debt costs, and even at housing and real estate. This is how you hedge against a potential rotation out of that big tech leadership.
And finally, strategy number 3. And this one might just be the most important. You have to start treating cash as your strongest weapon. After a huge rally, it's so tempting to feel like you have to be fully invested all the time. But look, volatility isn't going anywhere. Holding a reserve of cash gives you the power to act when everyone else is forced to panic.
So what are we talking about? A pretty good rule of thumb is to hold somewhere around 10 to 20% of your portfolio in cash or things that are basically cash, like short-term bonds. This isn't about being scared, it's about being prepared and being strategic.
I want you to think of it this way. That cash reserve isn't just sitting there doing nothing. It's an option. It is your ticket to buy quality assets at a huge discount during the next inevitable downturn. It's how you turn panic into opportunity.
So here's the bottom line. The market will always move faster than our emotions can keep up. You just can't outpredict it. But a well-designed, balanced portfolio that's built on a long-term plan, that can move faster than fear. It has its defenses up before the storm even arrives. Ultimately, the lesson from November is a call to shift your whole mindset away from the crazy ride of short-term speculation and towards the steady path of long-term structured investing. And if that's the journey you want to be on, then you're in exactly the right place.
Hey, if this breakdown helped bring some clarity to the chaos, hitting that like button is always a huge help. And to keep building out your strategic plan, make sure you subscribe for our upcoming deep dive into specific sector strategies for 2026. Thanks for watching, and invest wisely.